So with that, let's get started. Here's a quick agenda. This is what should look pretty similar. We've updated our format to be a little more concise, touching on some macro factors that are driving markets in some way, some of our thoughts on the different asset categories, whether it be stocks or bonds, and then we did add a special topic, a little more probably condensed than what I would normally do, but I think it's a useful framework on how to think about China, Chinese equities, bonds potentially, and investability, and how that relates to previous examples of what's going on in China right now, and that being Japan of '89. So with that, let's kick it off here. And, I thought this was a pretty appropriate picture to deal with or to reflect, maybe the current outlook on where we think markets are at the moment. Just kind of thinking about what's in front of us, walking downhill, certainly not a big deal, but when you introduce rocks along the way, that makes the departure or the line of travel much more precarious and makes you slow down and take your time. And I think that's kind of the approach we're taking right now with our investment portfolios. On the good news side, I think this is not one of those environments at the moment where good news is bad news, because that previously was the case in prior periods where, bad economic conditions would lead the Fed to ease financial conditions in a various shape or form. But we're now in a situation where I would say it's kind of a Goldilocks scenario where you've got a slight contraction still in manufacturing, but a kind of a reacceleration. That's the orange line here, kind of ticking back up. And remember, any number above 50 indicates expansion in that segment of the economy. So you can see after troughing for the better part of, or being in contraction for the better part of, call it a year and a half in manufacturing, it does appear the manufacturing sector is on the verge of turning into expansionary territory. On the services side, you can see we've been in an expansion for quite some time, really since post-COVID, with a slight deceleration, but actually numbers that came out today reflect a little bit of a reacceleration for the services side. So both the services sector is expanding as well as the manufacturing sector expanding. That's combining to lead to a pretty positive picture for the U.S. economy. That's in contrast to a lot of other places in the world, by the way. And we think, in this scenario, we're kind of in this Goldilocks era where Fed is kind of on hold, economy is tightening, or economy is growing, and asset prices, I think, are starting to reflect that reality. And just what I was referring to in the prior slide, why would we focus on, goods and services, and goods is just another euphemism for manufacturing. You can see actually how this kind of contributes to S&P 500 earnings. So this is the contribution to the economy. This is the actual flow through to actual S&P 500 earnings. And actually, what the point I wanted to make with this slide is that services sector make up actually a large part of our growth as an economy, but actually from a profitability standpoint, they're not nearly as profitable as the goods sector on a profit margin basis. So although the manufacturing sector is a much smaller part in total number of jobs, the contribution to S&P earnings is actually pretty significant. And one reason why we should continue to focus on what's going on in the manufacturing sector, because from a profit standpoint, it contributes almost identically. So anyway, I just thought this was a good way to bring that to life to everybody. And you can see the public sector, which doesn't turn a profit, the contribution that has to the economic growth in the U.S. Just dovetailing on to a question we got from last time, talking about, when will the debt and deficits start to matter? I think certainly we are approaching that point in history of our country where things will start to matter, although, we still have to be patient to wait, because you never want to make investment decision in the expectation before you see any sort of evidence starting to crop up. And I'll talk about where we're looking in just a moment. But, certainly this chart shows a pretty, not a great picture of the light blue line, federal spending as a percent of the economy versus tax revenues as a percent of the economy. And these lines are supposed to widen as time goes along, which, again, is not great from a budgetary deficit standpoint at the federal level. And one thing that we have to actually be monitor and mindful of, which we really haven't had to pay too much of attention to because the market has given us that flexibility to not have to do that as the world's reserve currency and the largest economy in the world. But I think certainly watching how these lines evolve over time is something that investors are going to do, because at the end of the day, a bond investor in U.S. Treasuries has to be confident they're going to get paid back. And one way that you get confidence that you'll get paid back is looking at how fiscal spending evolves over time. So I would say we're still keeping an eye on these dynamics. It's certainly something that's top of mind. We hear these questions a lot from clients. But at the moment, it's still not necessarily too big of a concern, because the market is telling you, primarily the bond market and the currency markets, that this issue is manageable for the time being. One, I would say, and that begs the question, okay, so how would we know if things aren't going right? And we need to start being more mindful of, budgetary issues, debt dynamics, things of that nature. And I would just point you to this chart right here, which is the US dollar index, which is basically a basket index against most of our major trading partners. And essentially, if the line is going up, that means the dollar is broadly strengthening versus our trading partners. And if the line is going down, it means in general terms that the dollar is weakening versus our trading partners. There's a lot of considerations that go into currency movements, but certainly one of them is how interest rates are in one area versus the other, but also creditworthiness. And I think that my message to clients is, or has been for a number of years now, we'll start to get concerned about the budget deficit and what that's reflecting within the bond market when the dollar starts to decline below certain trigger points. Now, this level right here is roughly call it 89 or 90 on the dollar index. That's just, I think, the first stop along the way. But I would say what we'd be looking for to understand if we were in a much broader systemic issue with the debt in the US is if this dollar index started to decline very rapidly versus our trading partners. And I would just point you to the example of Turkey. Turkey is the case study of fiscal mismanagement and using political considerations, hijacking their central bank. And I should have put the chart in this deck, but I could certainly follow up as a takeaway from this. But the Turkish lira has declined in value versus the dollar. I think it's 95% over the last 10 or 15 years since I think it's since Erdogan took power. So these things are really important to keep an eye on. Something that we take very seriously, and one, as a dollar investor, we need to be very mindful of. But I guess the takeaway is we're not terribly concerned at the moment, because the markets and primarily our currency is not telling us that we have to have concern quite yet. Just moving to our themes here for 24, some of which are similar and have remained fairly similar for a few iterations. One that it's different, and I guess maybe I'll just touch on the one that's different first. Meaning that there is, certainly some trouble under the surface in certain areas, but it's not quite systemic at the moment. And we'll touch on why we think that is at the moment. But certainly there's, troubles popping up in things like commercial real estate, most recently, with news stories on Bloomberg talking about how lenders are taking over certain assets from investors that were purchased a few years ago. Brookfield or Blackstone being like handing the keys back to lenders. That certainly is going on at the moment. And then also more recently in the commercial banking side, regional banks in particular, have had a pretty rough go more recently. I think that the KRE regional bank index is down, call it 50% over the last 18 months or so. That's a massive drawdown. In that drawdown in capital limits their ability to lend. So that's kind of a double whammy, because they've got commercial real estate on their balance sheet that is not in a good spot, and their capital base is declining because their equity is going down. So commercial banks are in a really tricky situation at the moment, which one reason why we have no exposure, of course. But I would say while these parts are certainly flashing some signals, it doesn't appear that this is kind of breaking out into the broader economy as an issue to be too concerned with, and pretty regulated and ring-fenced to some of those regional players and asset managers. Just a brief reminder, of course, politics does not equal financial markets. So making investment decisions based on what's can and potentially will happen in the 24 elections is not something we're ready to have too much of an opinion on right yet, because there's still a lot of ground to cover on the political side. And, certainly there's probably a news story every day about what's going on with the political or the Republican primaries. And, is Joe Biden going to be the actual candidate that makes it to the election day or not, are all, considerations. I would tell you, I was able to secure Mike Townsend for our October Market Matters. He's the chief political strategist for Schwab. And certainly we'll be sending out an invite for that. But we'll definitely be looking to some of the experts to tell us what the political tea leaves are saying at the moment. The other one I would say, which is really important, is that the Fed is very much in pause mode. But that doesn't necessarily mean we're in the clear. Certainly, they are likely not to be raising rates from here, but it doesn't necessarily mean they'll be dropping them very quickly. And as you may remember, that was one of our big risks coming into January, was that the Fed would not be dropping rates nearly as fast as the market expects. Now that has started to play out a little bit, where Jay Powell, the chairman of the Federal Reserve, has been very clear that they are going to be on hold until they see further data that would suggest they need to start dropping rates. But again, this is also one reason why we think we're still kind of in this Goldilocks scenario where the Fed is now on hold, economy is growing, and I think one reason why stock markets are now hitting all-time highs in the U.S. This recession question is still, I think, very much up for debate in a number of different circles, although it does appear that if there would be one, it'd be fairly shallow, given some of the underlying strength that the economy is showing at the moment. So this is not necessarily something we're too concerned with. Again, yes, there are things that are saying that a recession should be in the offing. So, inversion of the yield curve is one. The labor market now starting to loosen up a little bit. That's two, but just not enough confirming things to say that we are in some sort of danger zone quite yet. And as a result, our investment rankings have been fairly consistent with where we entered or exited Q4. So really haven't made too many changes within the portfolio relative to where we entered the year at. We did add mid cap. That is a position that is actually, part of this convergence idea that, yes, U.S. large cap is going to probably be okay for 24, but things like mid cap, which haven't done well at all in the last, call it 5 years, could find some sort of catch up if we have some stability in the interest rate market. Still have no exposure to emerging markets, at least directly. On our international stocks, it's all developed international equities. So think Europe, Japan, Australia, Singapore, within a diversified basket for those accounts that do have international exposure. On the bond side, we still remain fairly cautious, meaning that there is not a insignificant possibility that rates on the long end could start to rise again. That being the case, again, we kind of try to handicap this on a constant basis. That being the case, we still have a fairly short duration within our bond portfolio, although we did, after the October Powell pivot, as it's called, move our duration a little bit longer than it previously was. So think from ultra short to just a little bit short of the benchmark. That way, in the case that longer term interest rates do rise, our bond portfolio wouldn't be impacted very significantly. And then I think as well, our ratings across alternatives have stayed fairly much the same, where we do see opportunities within alternatives just across the board, whether it's in real assets or liquid alternatives or private alternatives. REITs, of course, still, I think we're pretty neutral on at the moment because of the issues that we just talked about with commercial real estate. Just to bring to life, why markets are hitting an all-time high, and likely will continue some of this momentum, is because the largest components of the S&P in the economy are surprising to the upside for earnings. Because as we know, markets don't invest on what has happened. They look 6, 9, 12 months to the future and try to project out where earnings will be. And this is kind of a manifestation of that. So coming into the beginning of the year, and hopefully you all have seen this chart. This chart just shows by sector and the S&P as a whole. What were the expectations for Q4 earnings here at the beginning of the year? That's the bottom line, December 31. And then what's actually been reported as of today, which today was February 2nd. And you can see why I think the market is hitting new all-time highs because number one, the S&P is very ever so slightly surprising to the upside from earnings versus what was projected or the expectation. But more importantly, in the largest, most important sectors of the economy, that being information technology, consumer discretionary, and communication services, these are all either tech or consumer related. Their companies are posting very nice earnings surprises to the upside. And where are we not seeing surprises to the upside? It's in things like financials. You can see a really sizable difference in the financials versus what the expectation was. And again, I think a lot of that has to do with write-downs in commercial real estate. The inversion of the yield curve continues to be an issue for banks as well too. So as you all may be aware, we have a very modest, if not very small exposure to financial companies within our single stock portfolio, as well as our diversified strategies, primarily for those reasons. Just a quick chart that I found here from Ned Davis that shows, if the Fed actually does cut rates, what has been the experience going back to, I think this is going back to 1921. So this is a nice, really full time series. So it's not a cherry-picked, 20-year view or something like that. This is a full encompassing view. And so I think the point is that as the Fed starts cutting rates, it's generally because there are, more challenging financial conditions on the horizon. But over that time series, on average, after the first cut, a year later, stocks are higher by roughly 15%. Now, certainly you could find time periods in here, like in the Great Depression in the 1929-32 era, or right after the dot-com bubble in 2001, or right before the financial crisis, interestingly. There were negative returns. But on average, I think this is a pretty high hit rate that things will be positive, particularly when you factor in a reacceleration in the economy is occurring at the same time. That leads us to believe that when the Fed does start to cut rates, it's not going to be because we've got a dire situation on our hands. It's that the Fed believes financial conditions are sufficiently restrictive and then it's time to ease off. I did show this chart yesterday in 2 Minutes with Todd podcast, but I think this is just a great, for those that weren't able to make it, this is just a great reminder of how different today's technology companies are and concentration in the market is versus where we were in 2000. Because I do hear concern from clients, which is justified, no question, that the market is very concentrated. Totally agree. And that it's rhyming a lot with the year 2000, which was the other kind of magnificent technology blow up that happened with stocks, which, many companies were down, 60, 70, 80% after the year 2000. And I just wanted to show you, this is a great chart from Goldman Sachs that just shows you a few things. Number one is the starting point of valuation in 2001, the estimate for 2001 was 43 times PE for the top 5 stocks in the S&P. And actually, top 5 stocks were a good number of technology companies, so Microsoft, Cisco, Intel, but there was also GE and Exxon in that top 5. And despite the fact there was Exxon's 21 times earnings, the average PE was 43. Contrast that with the current day Magnificent Seven, which have driven the majority of returns over the last 18 months or so. And you can see that at a much more reasonable 27. Now, again, I realize 27 is not something we should be celebrating as an amazing valuation entry point. But I'm just trying to draw a contrast that I think is pretty well laid out here. And then furthermore, if you remove the top 5, the S&P forward PE multiple was 23, which is, again, on average, that number should be 16 to 17. But if you remove the top 7 here in the today, you're right at that average number at 17. So, valuation number one is very different. Number 2, starting point is that expectations were quite a bit higher in sales growth for the top 5 versus the Magnificent Seven here today. So 16% sales growth, 12%, you might say that's trivial, but I think it's meaningful. And the big reason why these companies up in top five did not come through with any performance was because they missed sales expectations pretty meaningfully just across the board, whether it was Microsoft, Cisco missed very egregiously, Intel negative versus a positive. Really, I think stands to probably bring to life why I think 2000 is not necessarily a great analogy to the 2024 where we are today with the Magnificent Seven. And furthermore, from a profitability standpoint, I think every one of these companies is profitable, whereas in this case, Cisco, I believe, was not at the time. Just switching over here to bonds, we don't have a lot of data so far in 24, but I do think it's just worth noting it's been a pretty volatile start to the year where the market is still trying to handicap for a variety of reasons where longer term bond yields are going to actually migrate towards. Are they going to go down as the market thinks they will, or will they float higher if inflation and the economy stays pretty strong? So, this is, again, just kind of emblematic of a range of outcomes continues to be very much in question. In that type of circumstance, we would take a more defensive approach, which we are. And I think this next chart just shows you, as I showed last month, this is the MOVE index, which if you want to relate this, the MOVE index is to the bond market as the VIX or the volatility index is to the stock market, right? So it's just a proxy for volatility within the bond market. And it's just worth noting that even as bond market volatility has stayed high and elevated, that just tells you bond investors have a lot of anxiety as to where rates are going to land longer term. Whereas at the stock market has kind of looked through some of the more recent challenges for the economy and for rates and has now settled into a little bit of a lower volatility range. So this elevated anxiety level for bonds just tells us we still need to be fairly cautious with what we're doing on the bond side. And I reflected some of those positionings already there. So we're still fairly conservative there, not taking a lot of risk in bonds. Certainly not taking any risk in things like high yield bonds or emerging market debt, which to me just don't have the risk return we're looking for if we want to step out into those types of risk profiles. So just some key takeaways, and then I did see a question there that I'll certainly address before we get to the special topic. So similar to what I just reflected, 23, 24 is not a repeat or will likely not be a repeat of 2000. Yes, there's, I guess, possibilities that could manifest. But yes, while there are similar levels of market concentration driving stocks higher, valuation and growth expectations this time around are quite a bit different or differentiated. Not this time as different, but differentiated. Now is a great time to be managing concentration risk still, as well as the Magnificent Seven has done. We have been very active in trimming back those positions across our single stock strategies, particularly in the companies that have done the best. Think companies like NVIDIA or Microsoft. We've definitely been trimming those back to our target allocation level and finding, probably better valuation opportunities in other areas like, believe it or not, utilities or telecom or healthcare, energy are all areas that we've been fairly active in more recently. Still think bonds should be much more so for liquidity right now than for income, because if we had an income orientation here, we'd be stepping out the risk curve in things like high yield debt, preferred stock, emerging market debt. We just don't think the time is right to be doing that quite yet, because there are still some really good opportunities on the investment grade side that are liquid, like structured credit, I think mortgage-backed security bonds that we don't really have to reach too far out for on the risk curve. And then again, alternatives, whether they be public or private, play, I think, a really important role in diversification as a core diversifier. So whether the stock market or bond market go up or down, these things that are in our portfolio have been pretty consistent in generating the returns we're looking to achieve over time with low correlation. So we still think that's a great place to be migrating towards if you don't have exposure there already. Let me pull down the question here. Going back to my comments about the dollar, 22 countries have stopped using the dollar as the world currency. What does that mean? Or what does that bring? So as far as settling trade in certain categories of goods and services, yes, there's no mistaking that the BRICS countries have started using local currencies for trade settlement. There's no question about that. There are certain commodities, though, that cannot be settled in local market currencies, really, whether it be for transportation agreements or insurance agreements. So yes, there are countries that are now using other local market currencies to settle certain goods and services. But again, these are very small countries, number one. Number two, we are not necessarily exporting a lot of goods and services from the US as maybe a China or a Vietnam or something like that is. So less of a concern if you look at what we export versus what we import, because remember, we still are the largest economy in the world by a pretty wide margin. And that is a consumer-oriented economy that I think really negates a little bit of that delinking of the US dollar as the main trade settlement currency. And I think over time that is likely to continue even more, where more countries decide to adopt their local currency for trade settlement for a variety of reasons. But I'm not, smart enough to think that I know exactly why some countries are doing that versus the other. So I think my takeaway is until our dollar starts going down relative to other currencies, is when we're going to start having some concern about our dollar exposure. And maybe the game plan, if the dollar would be starting to go down pretty precipitously, would be looking at things like gold as a hedge for something like that. So let's move over to our special topic, which I just started doing some work on this. This is still fairly early days with this presentation, but I think it's in good enough spot to share. And it's really kind of correlating actually what I do think is a pretty good analogy. China of 2024 as it relates to Japan and where they were in 1989, and maybe some investment implications. So the thesis here is that those two countries have a lot of similarities in what was driving their growth, number one, but also export oriented, real estate boom, and now we're seeing the other side of that in China, which is kind of what happened in Japan. So some of the conclusions are, I think China is likely entering a deflationary bust that could last for a number of years. This actually is part of our thesis why, as well, inflation will potentially be lower than maybe it would be otherwise without this going on in China globally, because China is now exporting deflation through this drawdown in prices that they have. But I guess my summary takeaway is, deflationary busts are not good environments for equities generally. And China, in our opinion, is still uninvestable for probably a number of years to come. But if they get to a low enough price that reflects that full purging of the bad debts and overpriced real estate and things of that nature, then who knows? That could be an opportunity down the road. Deflationary busts generally limit bank lending, which is essentially what happened in the Great Depression here in the US, and also in Greece more recently, other areas. But these deflationary forces I just alluded to will put probably a cap on global yields, even though there is some potential for them to move higher for supply chain reasons. And the final piece here is that because of this contagion going on, or this issue going on in Japan or China, regional trading partners, stock markets could actually have some impact as well too. Unclear exactly what that's going to be, but thinking about Japan and how that deflationary bust impacted some of their trading partners, that could be potentially part of what's in store. Just to bring some of these ideas to life here, JP Morgan did this great chart showing, number one, on the left-hand side, household debt as a percent of the economy for both Japan in blue and China. And you can see household debt levels have risen pretty dramatically in China. I'm sorry, this is corporate debt. Corporate debt on this side, corporate debt levels have risen pretty dramatically, which is always a dangerous situation when you have a really sizable ramp up in debt on a short period of time, because you risk asset price dislocation. Then on the right-hand side, you've got household debt. as a percent of the economy, in relating that to Japan and China as well. Again, households in Japan and China really took on a lot of debt over a very short window of time, and that just puts these points in time, particularly around asset prices, at risk. So that's one similarity. The second similarity, I think, is really interesting to note is that deflation obviously is driven by a number of different things, one of which is population growth. And you can see now China, for the second year in a row, has entered deflationary population forces. So their population actually shrank for the second year in a row. Japan is actually, that's been the case. You can see this is the zero line here. It's been the case for a number of years now, actually since 2010, their population has been shrinking. But, it really kind of following a similar pattern of, kind of a ramp up. This is Japan here, kind of ramping up into the 1980s, late 80s, and then been on this slow, gradual decline. Similar situation is actually playing out right now in China with the idea, though, now that their population is outright contracting. Inflation as a result of, or should I say deflation, as a result of these deflationary busts is generally what occurs on the other side. So this is the Japanese inflation rate going back to the early 70s. You can see it spiked as they started exporting things like Hondas and Toyotas, Datsuns for the first time. And then right around this time, 89, is when their stock market peaked. And I'll show you that in just a minute, but you may remember this is when the Imperial Palace in Japan was actually worth more in dollars than I think it was the entirety of New York City. Something crazy like that. A lot of crazy property deals went on at that time, I remember specifically. But, deflationary, property busts always bring about this deflationary bust on the other side. And you can see Japanese inflation has actually been vacillating between positive and negative for the better part of 30 years, starting in 1989, and has only recently popped out of it from COVID, as in, some of the inflationary forces have finally started to kick in. But I guess the point here is that it took 30 years of declining inflation, i.e. deflation, until that economy was ready to reverse course. And you can see this is what I was talking about in the Japanese stock market, and this is a local market, so peak to trough, starting in the beginning of 1989, so January 1st of 89, to its trough in 2004, Japanese stock market declined a pretty visceral 80% roughly. Now it's just getting to that point where I think this past year, the Japanese stock market made a new high since 1989. So this is just how brutal it can be, kind of living through a deflationary bust. Very similar thing happened in the US during the Great Depression, but also more recently, there's other examples of deflationary busts that are right in front of us, one of which is Greece. Greece suffered during the European financial crisis following the great financial crisis that happened in 2008, has really gone down fairly dramatically, down since 94, down 90%. But even places like Ireland, where the Celtic Tiger was supposedly, reinvigorating that country, that stock market hasn't come anywhere close to a new high since 2006. Interestingly, Italy isn't anywhere close to a new high either. That happened back in 2006, and Spain. These are all, what I would consider various degrees of deflationary property busts. But Spain isn't anywhere close to their high seen back in 2007. But then you add in the U.S., and you can see what didn't happen, is that the U.S. kind of powered through after the financial crisis and recovered very rapidly, because a lot of the dynamism in the U.S. economy was not anchored to property or tourism, or really the financial system necessarily. Is more anchored in innovation, technology, science breakthroughs that have really powered S&P to new highs. And you can see the kind of annualized returns over here on the right over this time period. And then just looking at, China, where do they sit with their inflation rate? Where, well, because of, I think, demographics, some of the debt we just discussed, this is only going back to 2016. You can see now China is printed a number of months now of deflation, outright deflation in their economy. And I just think this poses a risk of further downside potentially to their stock markets, which again we have no exposure to, but just worth paying attention to because they are the second largest economy in the world. And you can see where they kind of sit within their stock market, how this has evolved. Peak to trough declines right now are right around 60% since the peak in 2021. That's actually a really significant drawdown in a very short period of time. But again, if you're going to use the Greece or Japanese example, or even the U.S. example of the Great Depression, you'd really want to see a number something like down 80% or so before getting comfortable that all the demons had been exorcised from those markets. So I think takeaways are, we still continue to have no exposure there. There's still probably some downside to Chinese equities, which could put downward pressure on bond yields and global inflation, and create some flare-ups, if you will, around the world. But something that we feel pretty comfortable not owning and not owning for quite some time. Very much appreciate your time. Look forward to speaking to you again sometime soon, and have a nice rest of your day. Thanks.